So for the record, I don't think there's any one right like asset allocation, right, or one asset mix that's going to dominate because we don't know. We don't know the future, right? For example, for the prior 10 years, US stocks have been international stocks very easily, right? But you look at the 10 years before that and it flipped, right? 2000, 2009, emerging markets absolutely crushed US stocks, which basically went nowhere, had that lost decade as they call it. Um, so I think the important thing to realize is we don't know exactly which assets. I just recommend people own income producing assets. And that's like a collection of stocks and I do this through index funds, right? So US stocks, international stocks, farmland, real estate investment trusts. It's like owning real estate, whether that's physical real estate, an investment property, whether that's, a REIT, which is managed by someone else and they own a bunch of properties and you just own a fraction of it, just like you own a fraction of a business when you own, stock in a company. So all those types of things, royalties, there's a lot of things out there. Some, some are more accessible than others, but the idea is to have most of your wealth, I say, 85 to 90% in income producing assets and the other 10 to 15% in what I call non-income producing assets.
Okay, Nick, let's kick off. Firstly, again, thank you so much for this. I really appreciate it. I don't think there's a better time to be speaking to someone like yourself than right now when we've seen markets being torn apart, equity markets, even ETFs, even obviously cryptos like falling apart the last couple of days, and people are scared. People are very, very scared at the moment. So I think there's two sides to it. There's obviously the theoretical side, like what should you do? How should you manage things? What should you approach yourself with mentally? But then there's also the emotional side of it, which people have, they feel this loss aversion whereby it's huge pain. So I think the idea for today, we'll get into some of those discussions as well as income and savings and stuff like that. So very topical.
Yes, I appreciate it. Yeah, thanks for having me on the show. And yeah, right now is a wild time in markets, but these things happen periodically. I mean, we had 2020, which I think was worse, but we can get into that.
How do you think that's played out kind of mentally in people's minds? Because I suppose, you've been around for many years, like you would have seen 2008, you'd have seen maybe even more of a pullback around 2012, 2013, and then there's 2020 and now 2022. Do you think there's a bit more fear that's around because like the Fed can't exactly step in? Well, they're saying they can't step in to help, grow stocks like they used to.
Yeah, so I wasn't really investing in '08. I still remember like my first week in college, like the market started to collapse in like early September, if I remember correctly, or like maybe it was mid-September, 2008, and the market just started to collapse. So I didn't really have any money invested. It didn't impact me like that. But yeah, I've been investing since 2012. And yeah, since then, this is probably the second. I mean, maybe December 2018 was kind of crazy, but it was very quick. It was over in like a couple of weeks. This has been going on for longer now. So this is probably the second worst drawdown since 2012, if I had to guess. I mean, the first being obviously, March 2020. And yeah, people are worried about the Fed and stuff. I try not to focus too much on the Fed. Of course, like in the short term, they matter, but in the long run, like the economy is far more dynamic than just the Fed, and everyone thinks, oh, the Fed, the reason that asset price is high is because the Fed's bought everything. And right, there's probably some truth to that. There's some little truth to that, but at the same time, like there were times when the Fed was unwinding its balance sheet. Look, from 2014 to 2019, they were selling down assets, yet the market kept going up. So it's not always perfectly correlated. Of course, there are times when it might be correlated, but I can't say with certainty that that's what's causing everything or what caused everything in 2021. So.
Yeah, it's interesting because even I saw your Instagram story during the week, and I dropped you a message off it around the news aspect of it. So since then, I saw your story, which was like, don't think about the news, like, go back to your thesis and follow your original plan. And like, I've actually turned off my volatility alerts across equities and crypto, would you believe? Just because I wanted to get removed from my head. I was planning on doing it for so long, and there's so much people are getting caught up in that, I think. Which is why they're kind of feeling more pain than anything else right now. It's because like there's this information coming in about this and that, and then there's like this shit coin going to zero, and I think everyone's kind of feeling that kind of more emotionally.
Yeah, I agree. And I think, I mean, there's a host of things going on. Bonds are like have had the worst return, start a year in basically, I don't know, 40, 50 years. And they're down bad right now. And if the year ended right now, it'd be like the worst return since they've been tracking the ag by like 3x. Like I think the worst return before was like -3%. Right now, bonds are down like 10% or something. So this is unprecedented for US treasuries to be down this badly. So I think that's another piece of this. Usually bonds are safe, and they haven't been so far this year. And so I think that's what's worrying people. And obviously, because rates are going up, it makes sense that prices would come down.
Yeah, there's multiple different areas we can get into. So we'll get into that aspect of too, which would be super interesting. I think we should start from the very beginning and kind of get into maybe the income and savings side of it first. I think it's super interesting. So I saw a lot of fascinating parts of your book, especially in the areas how as we increase our salary, our spending doesn't necessarily increase, which I think is quite interesting because maybe there's an idea out there that as you get that paycheck, as you get an increase in your bonus, maybe you might start plowing that into fancier things like cars and clothes and things that we don't necessarily need. Um, what does the kind of like information kind of say around that, especially the data? And I know you're a very data driven guy. And where did you kind of
Mhm.
come to maybe some of those kind of like realizations? Because maybe that wouldn't be the word like between me and mates and whatnot.
Yeah, so basically, I mean, I call this the law of the stomach. It's a very intuitive idea and the data supports it as well. But it's basically like if I raised your income 10x, whatever you're making now, let's say you're making, 50,000 pounds a year. If I gave you now you have 500,000 pounds a year, how much more would you spend on food? Would you spend 10 times more on food? Probably not. You probably would buy nicer food. You might go out to restaurants more. You might even, if you're making maybe 100x of that, you might even get a private chef, but you're not going to be spending 100x more on food or 10x more on food, right? So
Mhm.
that's the real reason how people save money. It's like if you look at the data, like incomes go up in one direction, but spending increases at a much slower rate. So, even though incomes could be up, 5 or 6 times from, let's say the median income, but the spending is only up 2 or 3 times, right? And so that difference is how you save money. It's how you invest, all those types of things, right? You have extra left over. So that's very clear in the data. It's very obvious. And so for me to say like, oh, you should cut your spending as a way to build wealth, unless you have a really high income and you're just being very frivolous, like that
Mhm.
can work. But for most people, that's not the way out. The way out is to grow your income because then like your spending is not going to increase as quickly as your income for most people, at least. And because of that, you can end up just building wealth. And I even have a chapter in the book where I do discuss how much of, let's say you got that new raise and you want to get a new car or fancy clothes or something. It's like or you got a big bonus, and the question is how much of that can you spend and still, stay on track, basically. And that's kind of a great question about raises. And I can definitely get into that if you want.
Yeah, of course, because I think it's kind of weird because I wonder what was the age demographic that you did your kind of study across. Just because for younger people, I think there's that element of lifestyle inflation. It's like, I've gone from 30K to 40K. Now I will go out more. And it's like, oh, even fractional changes in your salary, you could go to a nightclub, you could spend £80, £100, £120. It kind of scales a small bit. Does it get to a stage whereby when you get into maybe your 30s or whatnot, you're that's when the kind of stupid spending might kind of fall out, or like what was that kind of bracket? And there's also the other argument to this as well, is that as you get older, maybe you might get larger expenditure. Houses, kids are traditionally pretty expensive, aren't they?
Mhm.
Um, have you kind of scaled for that, as in like earnings and corresponding expenditure?
Yeah, so the data I had was just like across all households. So it's aggregated. So I can't see, so I can see like, okay, the bottom 20% of households in terms of income. I can't
Mm.
see the age breakdown. I know those people are generally going to be younger on average because we know if we look at the earnings data, like it's very clear that earnings go up. And I think they peak in like the 40s or 50s for most people. Probably, I think it's the 40s. So like your earnings should go up over time, and they're going to start to peak in the 30s, and definitely by the 40s they should peak out, and then your earnings are going to be pretty consistent from there going forward. So it's one of those things where, looking at the data, I hear what you're saying. Like, yeah, I have a lot of friends that went out and they started spending more at clubs or whatever. And that definitely happens. But I mean, it's hard to tell. Like, I don't have that broken out in the data to kind of tell you if that's the story that's going on. But you're right. Like, other expenditures come up as well. But all else equal, I mean, if you're making more income, like if you control for everything else and you're just hanging out with the same friends, and if they're assuming they're not making a lot more income, right, and you're just making more, then you should be able to save that, right? But
Mhm.
sometimes people they get carried away and end up wanting to spend more, and it's really you only get to live one life. So I'm not here to judge. I don't judge. I don't call like, oh, going out to a club a stupid expense. I don't think it's
Mhm.
stupid. I think it's like you got to live your life, and if that's what makes you happy, go do it. If you enjoy it, go do it. At the same time, like you do have to, as long as you're being somewhat responsible in the long run. I do obviously encourage people to save money, but I don't want them to guilt trip themselves every time they go and have a good time, right? I don't think that's a good way to live life.
Of course, and I kind of want to get into some of that as well. But I think that it's very interesting because it's like, especially if you're working really hard in your career, let's say your education, like you've done, you've been working in finance for so long, it's kind of like you want some type of reward to either fall back on or be
Hmm.
saving towards. It's kind of like you shouldn't just be working just to be blowing out the weekend. Now, again, people can spend their money, they can do whatever they want, of course. But I'm just saying, even from my perspective, I do want things to kind of show for it, not material things, but I'm saying you're building towards that long term wealth. Whether there's 101 different ways to get rich. You could be doing it of multiple different ways. It could be private equity. It could be index funds, ETFs, whatever. But there's different ways to do it. So that's why it's interesting to say that you should be kind of making that money work over time and progressively kind of working towards that. One area you discussed there about kind of increasing your income. So it's very interesting because there's two schools of thought. It's decrease expenditure or increase income. And I always compare it to if you're ever dieting from the gym, or if you're ever training, trying to get in shape, you always have two levers, right? You have the train more expenditure of energy, expend more calories, or you can cut your calories. And it's usually like you don't want to pull one too much, e.g., you don't want to cut your calories too much, just like you don't want to be trying to save too much. Usually the idea is you increase your expenditure of energy, and then as a result, then you will get that net benefit. And then when I heard your talks around increasing your income, it seems like a good comparison, because I suppose people get very caught up in the minutia of, oh, I should get the different type of bread or the different type of yogurts or the different type of whatever, and they get too caught up in those details maybe.
Yeah, I definitely think they do. I think like those things are minor changes and they're not going to really move the needle enough. And what is going to move the needle, as I said, is increasing income, finding ways, whether that's a side hustle, whether that's, finding ways to increase your income through your main job, or, there's a lot of different ways you can do this, and it just takes longer. It's going to take longer to do that, right? It's not the quick way. The quick way out is to cut spending, but it's not the sustainable path, in my opinion, right? Unless unless you already have a very high income and you just happen to be spending a ton, cutting spending is very difficult for most people. And I show some numbers in there. This is US households, obviously. And it's just like, I ask, where would you cut? Like, there's just not a lot of they're not spending that much money on average in these households. Like, it's like, there's just not a lot of money being spent. So I'm like, okay, where do you cut your spending then? Like, you're spending, whatever, it was like $700 on rent or something for like the lowest 20% of households. Like, that's not a lot of money. Could they be spending 400 and have a room? Yes, they could. Right. But it's like, where, at what point do you have to change your living situation and kind of get into a situation where you don't want to be in,
Of course, yeah. And I think rent as well is very interesting because there's so much things at play. It's like if you're living in the back ass of nowhere, of course your place is going to be cheap. Or if you're living on the outskirts of the city, so I know you spent some time in New York, or if you're there at the moment, like if you were to live obviously outside the city, it's going to be cheaper. But maybe the commute every day for a month past could always equate. And I'm actually moving to Singapore pretty soon. I had this exact dilemma. It was living in the CBD, pay a bit more, obviously a considerable bit more, or live further out, lose the time, and then have to actually spend on commute. So it's like it all kind of evens out. And it's interesting because I would have previously read Ramit Sethi, I Will Teach You How to Be Rich, which his kind of approach to this is that you don't necessarily have to cut out your coffees, but you do cut costs ruthlessly around the edges. So that was kind of his perspective. And when I was younger, when I was in university, that actually worked really well because, in university, it's a trade-off. Do I want to go out and just go drinking with my friends, or will I stay in, work on my education, whatever, and then save that money for, a vacation or whatever? And it kind of seems a bit more logical. But as I'm getting older, 26 years old now, I'm kind of seeing that sometimes that doesn't actually work out by cutting down on basic things that you need on a day-to-day basis.
Yeah, I agree. So I agree with his philosophy a lot in terms of like find what you really care about and what brings. So what I call is like bringing fulfillment. What's going to actually bring fulfillment for you as a person? Spend money on those things. And I think fulfillment and happiness are different. So something like, oh, I just want to maximize happiness. I don't think that's always the best way to go about. Don't get me wrong. I think we throw these words around interchangeably, but I really try to talk about fulfillment more because like. I give the example of like, climbing Mount Everest or something. That's something that's obviously not, I would say is probably not, I've never done it obviously, but I guess you ask those people, I would say it's not a happy experience. It's a grueling experience, right? But at the end, once you're done, if you've done it properly and everything, you'll probably feel like you've accomplished something. There's some sort of fulfillment from that, right? So I think that's the thing to think about is like, okay, well, is this going to lead to long-term fulfillment? And sometimes it's okay, just, hey, this is fun. It's happy, it's nothing wrong with that. But if you're doing that for too long, you might want to start to say, hey, is this actually going to lead to my fulfillment, or am I just kind of doing like momentary pleasure? Right? Thinking about those things and trying to optimize over the long term is probably more important, I think. So yeah, so that's why I say like, and I know it's very easy to attack people for spending. Like I'm like one of those people. It's like, I don't attack almost anyone's spending decisions. Like someone's like, oh, I want a nice handbag, or I want a nice car. It's like, I don't personally like those things. But then again, I go out to restaurants and drop what I would consider an exorbitant amount of money on a single meal, like on something I have it, it's in my body. Yes, I get the calories from it, whatever, but like I could have got that for, probably a 10th or maybe even 20th of the price, and I got calories and nutrition or whatever, right? So it's one of those things where like, it's not necessarily just about like, the food itself. It's more about the experience and everything. And that's what I like to pay for. And I have nothing really to show for it except memories and stuff. But other people have handbags or nice cars or whatever. And so who am I to judge this or that? The last thing I'll say on this is I think a lot of, the media likes to tell us like, oh, hey, here's what people like generally on average, right? On average, you look at the data, people like to spend money on experiences over things, right? That's generally true. But the problem with using averages is the averages may not apply to you at all. For example, let's say you're introverted, like you love reading books or something. For you, maybe owning a lot of books and sitting at home and reading books might be the thing that makes you the most fulfilled and happy and whatever. And it's not going and taking trips. You're going to hate taking trips possibly. I don't know. And there's nothing wrong with that. But the media is trying to give you the average result based on most people. And if most people are extroverted, they're giving you the solution that's not right for you. So I think at the end of the day, all this ultimately comes back to, whether it's money or anything or spending, how you spend your money, is know thyself. And this is like a philosophical question of like, how well do you know yourself? Is something that, philosophers back to the Greek days have been talking about, right? And it's like, do you know yourself? Do you know how you like to spend money? Do you know what brings you fulfillment, happiness, etc.? Once you figure that out, then your life gets a lot easier. So much of your life gets easier. But a lot of people spend so much time doing this and that because they don't know. And of course, when you're in your early 20s and stuff, there's going to be an explore phase, and you need that. You really need to explore and say, hey, do I like traveling solo? Do I like going to clubs? Do I like having fancy restaurants? Do I like, and you figure out what you like, and ideal over time, you kind of move your consumption basket into that kind of ideal, set of goods that, brings you fulfillment.
Yeah. And I think that's why people feel so guilty from spending money for sometimes. So like, let's say for instance, me and you are going out and it's fine in our early 20s and we're having fun. And then as we get a little bit older, if I stop getting satisfaction from it and you're like, oh, let's go out on a Friday, let's go out on a Saturday. And then I end up being pulled out. Then I'm hungover next day. I'm 200 quid deep or whatever. And that's probably where they might get that guilt in their brain. And similarly with buying things and keeping up with the Joneses, all that kind of philosophy is like, if you're just doing things to fit in, maybe that's why you feel bad about spending. I don't know. I don't have any data behind this, but I'm saying it seems just from a logical perspective, because for me, similar to yourself, like I live a very basic life in terms of basic clothes. I'm happy out having what I have. And then if I want to go places, it's usually travel. So it is usually experiences. And actually, oddly enough, something like even like apartments, as I mentioned, I don't feel too bad spending more than the average person on an apartment, just because I work from home. I like the place. It's central. I don't need much other than that. I have a couple of rooms in an apartment, which is ironic because it's only living with my partner, but I use it for office space and whatnot. So someone could look at that and think that's ridiculous, but to me, I value that, and therefore I can spend it and not feel guilt-free.
Exactly. Yeah, I think thinking about guilt, and that's like kind of one of the biggest things out here, is people just guilt trip themselves about everything, right? And like the thing I think COVID really did change how I think about spending money in some ways. I'm much more like, loose with my money than I used to be, only because like, imagine working your whole life, right? You're like 60 years old, you're skiing in the Alps in Italy, right? And this thing, you hear about this virus, you're going to be there the next 2 weeks, you hear about this virus in China, next thing you know, you're in Italy and a week later, and then you start to cough a couple days later, and you head back home, and then unfortunately you pass away. And you think about all those people that were, in their 50s and 60s, had no idea, probably in okay health, but got this random disease, which is kind of like a lightning bolt out of nowhere. And they saved all that, did all that time, spent all that guilt of working extra hard, saving extra, not spending, and all this stuff, all this discipline, just to, not get to even see get to even spend most of their wealth. Right. And I know that happened to so many people in COVID. And so when I think about that now, I'm not saying we should live this whole, carpe diem, spend everything tomorrow. Of course not. You have to still plan for the future as if you're going to have a future, because you probably will have one. Most people will. But at the same time, like, I think the guilt is not healthy plus on the stress effects. There's a great book called Zebras Don't Get Ulcers by Robert Sapolsky, and he talks a lot about stress. And I think the guilt and stress thing, the stress effect is very negative on humans and on our bodies. So if the less stress you can have, the better. So that's kind of my takeaway there.
It's interesting because like I even know some people that are kind of getting older now, and they're kind of saying, they're like, okay, I want to die with no money. You know, I don't want to be sitting on a load of bank. Of course, like, they can give it to an inheritance to their children or whatever, but fundamentally, they want to be able to spend and enjoy their money, which is interesting because you think as you get older, you may want to, I don't know, save it for whatever reason. There's always like the next thing. And we can get into some of that as well, because I know you've wrote extensively on that too. But looking at some of the income, which is very interesting. So I think really that earning potential is something that people don't lean into as much. And I think that's something I've been very, very hard on myself, maybe. It's the fact that I think I can always earn more. I can always push more. You know, I have my own kind of business and I'll have my regular kind of day job. And yeah, I think that there's always that aspect of it. Do you think people should kind of double down more on their strengths and focus more on that as well? Because pick up something on the side and do things on the side, so that then they can spend more, or then they can look towards building long-term wealth, investing and doing it properly.
Generally, I'd say, yeah, I'd say that's generally a good idea. But if you're going to do it, I would say you want to do it in something that you actually enjoy, because if you don't enjoy it, then you're always like the guilt's going to be there in a different way, right? So for example, for me, I like writing now. I didn't used to like writing, but now that I've done it for over 5 years, I enjoy writing. I enjoy writing posts, putting out content, things like that. So I'm always like, hey, I don't guilt myself in the same way, like, oh my God, I should be working extra to earn extra money. I don't think of it like that. I'm saying, hey, I enjoy writing. I like doing this. It's a part of my identity. And so I do it, and it happens to also earn me money. So that's kind of, I think, the way to kind of get around that. Of course, if the thing you love to do doesn't earn a lot of money, maybe not now, maybe it can in the future. And so you got to think about that, or some money, at least a side thing. So maybe you have your main job. I still have a 40-hour-a-week job. I'm not a full-time content creator. I don't know, these people get on there and do 20 Instagram stories a day and TikTok videos and this and a podcast and this and 4 blog posts a week. I'm like, I do 1 blog post a week, and I'm like, that's enough for me for now. Maybe in the future I'll try and do more content, but I'm never going to be the person that's like putting out videos every single day. It's just, I don't have the mental bandwidth to do that, right? Because I'm trying to put out very, very high quality stuff. I'm not saying you can't do that on the daily. I think it's just very difficult. You have to really, really be good at some level of editing, or some high level of just having the content plan or something. Yeah. Exactly.
You know, you need to build a little team or something like that, but then you need to be earning enough money to be able to employ that team.
It's like chicken and the egg. Yeah, it's like a chicken and the egg problem, right? Yeah, exactly. So it's one of those things where, like, I don't want to get to that point. Like, I like just having my weekly blog post, and honestly, I haven't missed a week yet. But even if I did, I don't think there would be a riot or anything. Everyone would be fine. The world would go on, right? So I think it's just about, like, when you're talking about earnings potential, you do need to think about, like, yeah, there's obviously you can be doing more, but you don't want to get into a space you're always guilt tripping yourself. Like, hey, I'm going to go out with my friends tonight. But you're like, you know what? I really could stay home and just do a bunch of work. And right, you could do that, of course, but I don't want you to like end up giving up your entire life to work either. Because like one of the regrets, you know, there's a great book called like The 5 Regrets of the Dying, or maybe it's called The Regrets of the Dying. And they talk about like, what are the biggest regrets of the dying? And one of them is like, people, A, is too hard on themselves, and B, people work too much. Like, those are 2 of the 5 things, right? And it's like, you know, people are like, I wish I hadn't worked so hard. That's like literally one of all the people dying. Remember, these are people on their deathbeds, and there's like literally a huge sample of data of people saying, I wish I hadn't worked so hard. So I'm not saying not to work hard at all, like, but I'm saying like have some balance, right? I think a lot of this is about balance. And the book, Just Keep Buying, my whole idea there is like balance. Let's kind of have a balanced approach to this, right? And so that's all I really want to do. That's the message I want. It's like, stop guilting ourselves so much. Stop saying, oh, we're going to probably run out of money in retirement. That's probably not true. You know, I think a lot of these things are, you know, kind of my message I'm trying to put out there.
Yeah, because I think people kind of get really into their career and actually enjoy it. Because same with me, like, as in, I actually enjoy, of course, recording podcasts, doing things on the side, creating content, putting things out on a daily basis. And because I enjoy it, of course, it's difficult at times, but I can lean into it a bit too much and say, you know, on the Saturday or Sunday, I won't bother going for a walk. I won't bother taking some time off. I'll just put time into this because it benefits me. But it may benefit you, but it might pull back on other aspects of your life. So it's about having that control, I think, and setting those hard and fast rules. When you do start making money from that, though, how do you proportion that in your head? Like, should you, you know, be constantly thinking, I need to put this towards my fund, you know, I need to put this towards investing, or should I have it and enjoy it? Because I always have that dilemma. It's like, you know, if you're getting paid for something, where do you put it? What do you do? Should you reinvest it? Should you put it somewhere else? Should you put it in the market? And I know, of course, that's situational base, but maybe do you have any numbers around like how people split this out? What's the general rule of thumb?
Every person's different, right? That's one thing. And my saving advice has always been save what you can. And what do I mean by that is I don't give you like, save 20% of your income. the issue is incomes are volatile, especially if you have like a side hustle or like a side gig where you're making side money, where one month you can make a lot, another month you can make differently. So I think doing, especially if costs are changing over time too. For example, when I was in Boston, I used to live in Boston, and I was saving like 40% of my income because costs were cheaper. I had a roommate, spent like 1,600 a month. Like I was making good money. I moved to New York. I started living by myself, and my rent went from 1,600 to like 2,800, right? So it was a big jump, and I'm paying 2,800 USD a month, right? So obviously my savings rate dropped a bunch from that, right? And so that plus other costs, everything's more expensive in New York. So my savings rate went down, and I could have just said, oh my gosh, I'm not saving enough, and beat myself up. I said, you know what, let's not worry about it. So for like 1 year, I didn't really save much money. I saved very little money compared to the year before. I was saving 40% of my income, which is a huge amount of money. And I didn't beat myself up for it. And I think the point here is just to save what you can. So in this case with my blog, that's all basically upside. Like I could go and spend more of it, but I don't really want to. I'm already living the life I want to live. I'm already going to the restaurants I want. I mean, there's only like probably a handful of restaurants in New York City that I think I'm priced out of, excluding like buying $1,000 bottles of wine. So let's say I just get a normal cocktail, right? Or a normal beer or whatever I'd get. And then I just have the meal. Like I'm only priced out of maybe a handful of restaurants in this city, right? Where I would feel like, oh, that's a bit much to spend. Like there's one called Masa where it's like $950 a person for like a tasting. I'm like, I'm priced out of that. I'm not going to go spend, I think it's irresponsible for me to go spend 950 USD on, on a, or 950 times two, right? All in, it's probably like $2,400, with drinks and everything else, right? So I think I'm priced out of that place for sure. But most places I can go to and I don't worry about it. And if I want to go there, I go there. The hard part is getting a res most of the time. That's really I'm not priced out. I'm just like resed out. If anything, like I'm like, oh, how do you get a res there? You got to do this, or you got to have a special car or something. Like a lot of these things, that's kind of where, that's how I think about it. So what I would say to you is like, how should you think about money? Just try and live the life you want, right? And you're like, but I want to fly private. Okay, then maybe take that, have some reasonable like expectations for now. And then if you want to do the private thing or some other really high, you have to be earning so much more, right? So try and live a reasonable life that you think is fair and like, hey, this is close to what I want. And then, save the rest, right? That's kind of my thinking on it. So
do you think you should be setting like standards? I know you mentioned there like 20% of like savings. So forget about how much the saving rate is, but should you say like, okay, if I want to live this lifestyle whereby maybe not flying first class, but you want a 2,800 apartment in New York, I need to hit 80K this year, 90K this year, and have maybe an actionable goal to work towards. Even for myself, I remember like when I was trying to hit like 100K a year, put myself under a lot of pressure on it for sure. And I definitely was thinking about it a bit more than I should have. But I definitely felt that it 100% helped me be a bit more aggressive with how I approach things. Just being like, I should stay on top of it. I should just get this right, get that right. I don't know, was that net benefit for me? But definitely from a objective perspective, it let me move closer towards the goal line.
Yeah, I think being motivated is helpful. And so like when I talk about like getting rid of guilt, like I think it's the amount of guilt that matters. A little bit of guilt is okay, I think, and a little bit of that can kind of push you in the right direction. It's just I feel like our society is overwhelmed with guilt on everything. Every time you spend money, oh, you're buying coffee, you're pissing away $1 million, right? That's like that's the phrase here in the United States. So when every single purchase is oh gosh, I'm destroying my future. Oh, I'm gonna have to work longer, retire. Like every time you think like that, it's just not healthy for your mind. So whatever's gonna keep you like mentally healthy, low stress, whatever. And if it's like, hey, if you got to give yourself I think a little bit of stress is okay. And so if you're gonna give yourself just a little bit of that, that's fine. That can be helpful, but you don't want to be in a chronic stress state. Otherwise, you're just not. I mean, that's why I think so many people in like that are low income, in the United States or even around the world, their lives are tougher because they're in a constantly stressed state to worry about money. And it's like to think about like, I mean, it's a privilege for me to say this, but like, I don't have to think about like, oh my gosh, where am I going to get money for my next meal? Or am I going to have enough money to cover the rent? Right. It's a complete privilege. I completely understand that. And so I think for those people, they obviously have to make more, have to find ways out of that. And maybe that's going to take a couple of years to get out of that. But once they can, I think then they can start to breathe a little bit easier. So there's, and for those people, yeah, you might need to guilt yourself a little just to like, hey, I need to work more. Cause like, otherwise I'm going to be in this cycle for forever. And if you actually look at the data, those people that have, negative, financial events happen to them, those same people, they usually get caught in these cycles. Like, it's like, I can't remember. I put it in the book. I need to find that number again, but it's like most of the like negative financial events happen to like a very small percentage of people. And it's just like over and over. Like, it's like, oh, I had a financial emergency. Most people will get one within a like a 10-year span. Almost everyone gets a financial emergency at one point. But, you know, there's those people that are just constantly in that because then, oh, then that breaks, or like, oh, my car broke down. So then after that happened, I had to go borrow from this person, but then I couldn't pay them back because then this thing, right? And then they start getting so deep into a hole and they can't get out of it, right? And so, yeah, you got to be real careful there. And so in those cases, yeah, you kind of have to be a little bit more mindful of how you're spending, but most people are not in like a deep, deep hole like that.
Yeah, it's like setting hard and fast rules, but then taking them with a grain of salt. It's like, this is what I should be doing. It's like the health analogy again. It's like, okay, I don't want to be Ronnie fucking Coleman and absolutely shredded all year round. I'm happy to be in a good condition, eat well, and then of course at the weekends, then you can have a meal with your family or whatever. So I think it's like it's a balance element too, and I think that was obviously more optimized for fulfillment, as you said. Maybe you could have scraped it a little bit more on the bottom of the balance sheet, but fundamentally, that's not what you're optimizing for. You're optimizing for lifestyle, for health, and general like longevity, I suppose. I want to get into the investing side of it because I suppose that's what a lot of people will be looking very interested in right now as well. So just keep buying. Very interesting because you have the element of, you know, constantly dollar cost averaging, working through, and just, you know, over the long run, no matter what the news says, no matter what happens. What's some of the data around this in terms of what you were looking at in terms of what were the different type of asset classes, and generally like how do you kind of set this up from even a portfolio perspective?
Yeah, so I looked at a bunch of different asset classes, and so for the record, I don't think there's any one right like asset allocation, right, or one asset mix that's going to dominate because we don't know the future, right? For example, the next 10 for the prior 10 years, U.S. stocks have beaten international stocks very easily, right? But you look at the 10 years before that, and it flipped, right? 2000, 2009, you know, emerging markets absolutely crushed U.S. stocks, which basically went nowhere, had that lost decade, as they call it. So I think the important thing to realize is we don't know exactly which assets. I just recommend people own income producing assets. And that's like a collection of like, you know, stocks and I do this through index funds, right? So US stocks, international stocks, farmland, real estate investment trusts. It's like owning real estate, whether that's physical real estate, an investment property, whether that's, you know, a REIT, which is managed by someone else and they own a bunch of properties and you just own a fraction of it, just like you own a fraction of a business when you own, you know, stock in a company. So all those types of things, you know, royalties, there's a lot of things out there. Some, you know, some are more accessible than others, but the idea is to have most of your wealth, I say, you know, 85 to 90% in income producing assets and the other 10 to 15% in what I call non-income producing assets. So that could be things like crypto, art, gold, wine, whatever, these things that I think don't really have income associated with them. I think those things are, you know, more speculative. And so you should keep them to a minority of your portfolio. So I say 10%, 10 to 15% at most. The other, you know, 85 to 90% should be in income producing assets. And the reason for that is very simple. Like, you know, income producing assets have fundamentals. There's a cash flow associated with this. It's not just based on what other people think it's worth. Now, of course, at any point in time, the price of a stock or an index fund, you know, that you go to buy is going to be based on feelings. Like, of course, it's always based on what people think it's worth. But at the same time, there's some kind of weight, some fundamental earnings that are there, right? Versus like a cryptocurrency is completely based on what people think it's worth. And I'm not saying there's no value to cryptocurrencies. I'm not saying that. There is some intrinsic value of having this private, like blockchain wallet, whatever you want to call it, this private area where you can have things that you can then send to someone else across the world and no one can stop you, or you can move that capital across the world, right? Just by knowing a seed phrase, you basically have a private bank anywhere on the planet, as long as there's someone else you can transact with for those coins. So there is value there. The question is how much value, and I don't know. I don't know what price is fair for that, but that remains to be seen, you know. And I've heard people say stuff like, well, what about staking with crypto? Can't we, like, you know, can I just stake I lend my crypto out and then I make, you know, 20% a year or something. But that's just what happened with the Luna Terra thing. Like, people were like, I'm gonna get 20% a year, you know, lending out my Terra. And then like they depegged and it just went to, you know, it just did not do well, so to speak. I don't use crazy language, but it just went very badly. Yeah, it went very badly. So you can tell me, oh yeah, I earned 20% a year, and then your underlying just went down how much? 90%, whatever it was, or 50%. I don't even know which one. It depends which one we're talking about, but like it just went very badly. So Luna's down like 99%, and it's like, people are like, but I was making 20% of my money. It's like, yeah, but your underlying, like when I make, you know, the reason why the bank doesn't pay much is because when I get my money back, I know it's going to be the exact money I gave them. It's just going to be reduced by inflation. So you're going to lose, take an 8% haircut a year, versus when you're staking, you have no idea what the coin's going to do, right? The coin could be down 50% when you get it back. So you make 20%, but you lost 50%. Like, so what do you're down 30%? Like, no, you don't want to do that, right? So yeah, that's kind of my take on crypto. But yeah, I don't think there's any right asset mix. And so I just generally do like, I have US stocks, international stocks, REITs. That's most of my income producing assets there. I do have some bonds as well, US treasuries, because I think they're the safest out there. But yeah, I don't think there's a right way to do this. But yeah, if you want me to expand on any of that, please let me know. Yeah.
Of course, of course. I think it's interesting because it's like the risk profile of these as well. It looks like when you're looking at the likes of REITs, index funds, ETFs, whatnot, it's much more geared towards the long term. So, like if you're making a yield of 5% a year, whatever, people say, "Oh, 5%, 5% of 10K is fuck all." You could put it in crypto, whatever. And it's like, okay, yes, but the longevity of it is much more geared towards the long term because we have the past data of the last 50 or 80 years, whatever you've pulled back on. And now again, of course, like I'm not shitting on crypto. There's obviously a limited amount of data, and of course it might work in the future. So it's not to say that it won't work, but it's the fact that it looks like to me that some of those, staking and I'm very interested in staking, and I'm having someone on my podcast soon to discuss like how these staking pools even work. So because I'm not like necessarily against it, it's the fact that I feel like it's like kind of Trojan technology, a small bit that we don't necessarily know what the reward is. And even if Terra Luna at the time goes up 300% over the course of 18 months, then after 5 years, to your point, you go back to fucking zero. So it's kind of like it does take a place in a portfolio, of course, but if you're trying to build proper long-term wealth, it will be a proportion of it, not necessarily all of it. If you're thinking longer term, like as in if you've seen crypto millionaires make it over the course of a couple of years, that's fine. But I'm saying like if you're investing in the likes of a couple of altcoins, the probability is that the fact that they're startups, majority of them will fail over the long run because that's what statistics will tell you. So it's kind of like you need it as a proportion, So yeah, it's very, very interesting on that side of it. And then maybe back on the kind of index fund of it. So when you're looking at that and kind of thinking of it, how do you dollar cost average across there? Are you usually just doing it from your salary, from your income, on a monthly basis, on a weekly basis, and then letting it grow? So like, let's use hypothetical numbers. If you're on 100K and you move company in 150K, do you still put in like the 10% a month, 15% a month, and then irrespective of where it is, you just keep on going through that kind of process?
Yeah, so I'm buying in my 401k, my retirement account here in the US, every time I get paid. And that's a mix of, US, international, REITs, and bonds. That's kind of my main ones I have. But then every quarter I take whatever excess money I have from like I get paid quarterly from my company, but I also take the money out of my business every quarter. I use quarterly, I pay my estimated taxes, everything, and then I have my extra. And so basically every quarter I'm doing this, right? I'm taking this money and I'm kind of getting it invested. And so I just do that because it's easier. I mean, I could, in theory, like I know it's called just keep buying. And I say you should be like, oh, every time I get paid, I should take that money and put it in. And I agree technically that's going to be more optimal, but it would just take so much more time to always constantly be investing and trying to track everything. So I just do it once a quarter. And I'm just looking like, okay, hey, what's underweight relative to other things? And so I might buy those underweight things a little bit. And so I might do that like really once a quarter. I mean, I do a full rebalance every year, but like if I have a little excess cash, I'll say, oh, hey, maybe emerging markets, they're down a little. Maybe I'll add some to kind of get them back to their core weight, right? If I had them at like, let's say, I don't know, 20% of my portfolio and they're at like 16%. I'm like, you know what, let's add this excess money to try and get them back if we can, right? Just things like that. I'll just do little purchases throughout the year, a couple purchases a year where I'm just on top of my consistent, 401k purchases, which are happening every 2 weeks, and that's the other thing too.
Would you say that's quite active? So as a result, you're pretty much kind of actively, I know you're rebalancing yourself and you have the technical and the mental awareness to be able to do it, but would that make it quite of an active portfolio you're kind of managing?
I would say it's very passive, but I mean, the only active piece is just the rebalancing. And what I mean by it's in what I call an accumulation rebalance, which I talk about in the book. And the difference with a normal rebalance, what you do is you sell the overweight asset and you buy the underweight asset, right? But I don't want to sell anything. Like I hate selling because there's tax reasons for that. Obviously, if they're in like non-taxable accounts, you can do that easily. But I generally just want to buy the underweight thing. And so if I have extra cash, if you're working and earning money and you have extra cash, you can be like, hey, this thing's underweight. I can just buy it back up, right, a little bit. So, and that's kind of like, quote, buying the dip type of thing. But I'm not waiting. I don't sit with a bunch of cash and just wait and wait and wait. I never do that. I'm always, as soon as I have the cash, I get invested. It's like right now, markets are down bad and people are asking me, Nick, have you bought the dip? What are you doing with all your, like, I don't have any excess cash. I've already bought it. I'm already invested. Like, I'm not sitting around, because I know that strategy over the long run is going to make me more money than sitting and waiting around for a dip, because I can wait around and then it doesn't happen. And then I'm just losing money to inflation. So most of the time, you know, my strategy of just getting invested as soon as possible works. But once in a while, it would have paid to wait, you know, it would have paid if I just waited a little bit, but I didn't know that, you know. I've been doing this since 2017, and every single time besides, you know, February 2020 and in the last month or two, it would have paid to not wait. And it's only these two occasions where it would have paid to wait. So you can see of the number of months that is, right? Let's say, you know, 60 months or so. Of those 60 months, you know, only in, you know, 2 or 3 of them, or let's say 4 of them, you know, less than 10% of the months, does it even make sense to like have cash sitting around? Because most of the time you wouldn't need that, you know? So that's the takeaway.
It's always like timing the market beats timing the market, really, and trying to get it right and wait out. I think it's like people just get really scared though, you know, especially now, like trading volume's really low, you know, in regular equity markets across a couple of platforms, but it's lower than usual because people see it and they're like, they look at let's not even look at stocks for the moment. They'd even look at index funds or look at whatever. And then, because the index funds aren't that popular in Ireland in particular because the fees are pretty high. And the fees are high on ETFs as well. We can get into that. Some of the exchanges around Europe they're pretty high. It's a kind of an older model than the US, I would say. But anyway, so they would look at that and then they would fear that it's going to keep going lower and lower and lower, and we're going to go into a recession. We're going to do this, and it keeps people off. And even me, like I'd look at it and I'm like, fuck, I don't know. I don't necessarily have the same confidence. And it's funny because I've had like many different people on my podcast discussing like investing and financing and everything. And a guy mentioned before, he said the market's the only place where people buy it when it's more expensive. They'll actually only buy it when it's more expensive than anything else, because they need that confidence from other people that they can, I don't know, you know, that the other people are going to buy it.
Yeah, no, I agree. Yeah, it's one of those funny that I think the Buffett quote is, it's the only place where, you know, when everything goes on sale, everyone runs out of the store, right? So it's very interesting and dynamic, right? But and I think the issue is just because, you know, at the end of the day, I mean, psychology rules most human behavior, right? People are going to say, oh my gosh, this time's different. This is the real end, this or that. Like, and we just saw this 2 years ago. I think 2020 was like probably the best example of this. Like, if there's ever a time to be scared, like I can't imagine like, just like you're watching the entire global economy shut down, like, and the market only went down 33%. Like, that's shocking to me in such a big way, because, you know, you think a shutdown of the entire globe like that should cause more than 33%, but it didn't. And it was only down for, you know, whatever, from the peak to the trough was, you know, a month and 4 days or something. And then within 6 months from that, we were back at an all-time high. So just absolutely things that you could never imagine. But that's kind of how it works in pandemics. That's usually what happens: quick crashes, quick recoveries. And that was true in basically all of them: Ebola, SARS, etc. It's quick crashes, quick recoveries. So yeah, of course, at the time, I wouldn't be like, oh, I'm confident this thing's going to come back, because you don't know. I mean, the global economy shutting down, the pandemic was far worse. It was basically Spanish flu level, but maybe even worse, because we knew the information more quickly, so we could kind of shut things down more quickly, right? So I think that's what's super interesting about that. But yeah, it's just like, you know, human history just kind of repeats in many ways, or it doesn't repeat, it rhymes, as Mark Twain says. And I think it's one of those things where, like, this happens, this type of thing happens, and you have to get used to it and don't run out of the store, relax. Like, I know you see everyone else running, but you have to realize, like, evidence matters, right? You know, one of my favorite quotes from Jeremy Siegel is, fear has a greater grasp on human action than does the impressive weight of historical evidence. And so, like, I'll say that one more time: fear has a greater grasp on human action than does the impressive weight of historical evidence. And I think that will always be true. And that's where you can kind of have a little bit of an edge, because people are going to freak out. They're going to panic. They're going to run. And it's like, what good is if we go into like an apocalypse type scenario, a Great Depression like scenario, like, what good is your money going to be anyways, right? Like, I mean, don't get me wrong, like, money's still something, but if this is the apocalypse, it's not going to matter. Your investment portfolio is the least of your worries, right? And it's the same thing with like the Great Depression. Like, people's investment portfolios is not the issue. Is like, can I get a job? Am I gonna get food? It's like, there are far more primal needs that need to be thought about first before you can even consider like your investment portfolio and retiring on a beach. Like, it's silly almost. It's like the world's in a place of panic. So that's why I look at investing, especially in like, you know, stocks, things like that. It's just like income producing assets, like it's an upside call up. It's just a call option on the future, right? As long as we don't have like a world ending nuclear war, or we don't have a, you know, something that just really is like apocalyptic, then there's really no downside, right? Like and if there is, and it's like, okay, well, what good is your money going to do anyways? You're going to need guns and canned goods and gold and who knows what else to like live in society, right? So I just say, like, as long as that real crazy tail edge event doesn't happen, and I don't think it will, you'll be good. So invest, right? It's a very simple premise. And so, of course, it's not going to be easy to do that. It's easy to say that now after we had a 10-year bull market or whatever, but it's like, at the same time, I'm like, hey, this sometimes happens, and I'm still very positive for the future. I think we'll get through this just like we get through everything else. I hope the conflict in Russia and Ukraine is kind of, solved in some way. And so it gets, that ends soon and everything. And we kind of move on and we don't do stuff like that anymore. And but that's where we're at right now.
Yeah, it's difficult because there's so much different things at play. Like you could even see like, supply chains, all the container ships that are outside Shanghai. Then there's obviously the war going on, commodity prices increasing. And then you have like the Fed. So people are, they have this reaction that it's going to take longer. Of course, in 2020, we didn't know it was going to bounce back so quickly. It's difficult like that to understand, but I think you need to just understand, look at the data, see it's always bounced back. And that's where it gets kind of interesting because, I've seen a lot of things on Quora recently. It's like, should you sell? Should you sell in this scenario? Whatever you're holding, if it's a whatever. And the whole thesis is that like, you can lose 90% and I could come back, but then you could also lose 90% of that 90%. And then of that 90%, you could also lose another 90%. Technically. So, people are saying, well, this is what I'm kind of reading. It's like, you should still set stop losses for when it goes on beyond past no return. Because I don't know the exact numbers, but when a price of something loses 50%, it needs to make like 150 back or something to get back to 100. Yeah. So it's always matching that number. So, is there a case there? What's your thoughts on this on this idea that if something falls so hard, it may not make a recovery at all?
Well, the question is, what do you own? I mean, do you own a index fund of a basket of US or world stocks? I mean, if you think world stocks will never recover, then, I mean, what type of world is that? I mean, it's almost it's not apocalyptic, but it could be like a dark age of some sort, right? Which is obviously possible. I'm not going to say it's not possible, but that's my question to you is, what do you own? If you own an individual stock, like, yeah, there's nothing that says any individual company has to come back. There's absolutely nothing, right? And of course, there's nothing saying that any individual market has to come back, but the record of history across most equity markets most of the time is that they do recover, right? And that's the key. It's like there is this kind of, growth that will happen, and there's some of the bad companies get swept away, the risers come in, and we keep moving forward. And that's kind of how the U.S. economy has worked, and that's how a lot of economies have worked. There's always exceptions. What about Japan? What about Greece? 2008? What about Russia right now? There's always exceptions to this. I would say Russia's was kind of self-imposed, so I don't even want to count. I mean, I don't want to count that in the traditional way, but like if you have someone who's basically a dictator and they kind of they can do whatever they want, then your equity market is susceptible to violent swings in pricing, right? So you have to realize, like, hey, should I even own Russian stocks given this, right? You have to think about that. So my counter to that is like, what else are you going to do? Like, it's like, okay, if your stock is down 90%, like, you're like, oh, should I sell it now? It's like, you shouldn't have bought it in the first place. Like, you shouldn't be owning individual stocks because they're so risky and they have a lot of this, owning these like Luna crypto things. And you're like, well, I already did. It's like, then yeah, maybe you need to get out and that's your lesson, right? I don't know what's going to happen to these things, right? Because it's not like an index or a stock, which has a long history of like creating wealth. It's something that's very idiosyncratic, it's very specific, and we don't know the future of it, right? It's the same thing with crypto. And so I'm actually kind of a general fan of crypto. I just think obviously it's gotten a little ahead of itself, right? And so I'm not here to like talk, trash or anything or say anything bad about crypto at all. But yeah, it's like, we talk about staking or whatever, and it's like, this thing doesn't have enough history for us to truly judge it yet. And I think that's why I was very skeptical of staking. People are like, oh, there's all this money and all these things. And I'm just like, yeah, but it has no history. Like, there's all these unknown risks. And one of the unknown risks just played out with Luna and Terra. It's like the exact type of thing where like, I'm like, you don't know the risks with this coin. You really don't, because no one does, right? And to say you do is kind of, seems kind of wild to me. So that's the only thing I would just be like, hey, if you're in one of these scenarios where you're down 90% on a coin or a stock or something, like, I can't tell. There's no good advice I can give without you getting mad. I can say, get out. And if it goes down more, you're like, wow, that guy's a genius. And if I say get out and it comes back or something, you're going to say I'm an idiot, right? So I don't know, because I don't even know what company you're talking about, whatever. I would just say, if I were you, I would get out of most of those and just get into a diversified portfolio, which has a better chance of building long-term wealth and not declining by 80-90% in most periods, right? Of course, Great Depression is an exception, but outside of that, there's no other recorded point where, global equity markets were down 80%, except in the Great Depression.
Yeah, it's cool because I think a lot of people get these learning lessons the hard way. They'll go through stocks or shit coins or whatever, and then they'll learn the hard way, and then they'll come back and make those better decisions. I don't know, they've probably learned their lesson the hard way. It's very, very difficult, but depends. It's going to get people base knowledge, and then after a while, then they build up to understand what they should be holding, what they shouldn't, and then take a different approach. So you speak a lot about stocks. We've already talked about it, but why is it you're not a fan of stocks in particular? And why?
Stocks,
of individual stocks. What's your thesis around that? And what does the data say around that?
Yeah, so the data on that's pretty clear. There's these reports called the SPIVA reports, SPIVA, SPIVA. You can go look them up. And basically, what these reports show is no matter which equity market you look at, the US, UK, international, wherever you're looking, the active managers, the stock pickers, do not beat their benchmark. They don't beat the market, basically. So in the US, they don't beat the S&P 500. In other markets, they won't beat their underlying benchmarks. And so because of that, the data is very clear that you probably shouldn't be a stock picker either, because if the professionals can't do it and they have resources and teams and all this, what chance do you have, right? That's really my first take. And some people are like, well, I'm exceptional. I'm like, okay, well, let's say you are. Let's think about this, right? You think you are, but you don't know. And my second argument, if you don't buy the first argument, which is you're probably going to underperform. If you're just doing it for fun.
Can I ask you one question on that as well, on the performance? So I heard you speak about this previously as well in relation to the fees and kind of all commission and stuff. With all of that aside, because we have zero fees or trading and we can get access to markets instantly and whatnot, is that still a factor? If you were to eliminate all fees, can you still potentially beat the benchmark?
I mean, anyone could beat the benchmark, but it's the fees is the fees the manager is charging. So let's get rid of those fees. Let's ignore that. Let's just say there's no fees involved. On average, I mean, remember, the active manager trading between each other, right? So half of them if there were a no fee world, right? Half of them would win and half of them would lose on average, because their returns together become the market, right? So on average, right? And so the main takeaway here is they're buying and selling from each other. So half of these people have to be above the average and half have to be below. So just off that premise, you're going to be above or below. Once you add fees and transaction costs, you have to be below, right? On most of them have to be below, right? Because once you include those extra costs, the benchmark is going to do better because you don't have to pay those fees, right? So as a passive investor. So that's one piece of it. But I think the second argument is actually more compelling, which is you don't know if you're actually a good stock picker. And I think the issue is with most things in life, you can usually tell pretty quickly if you have skill. For example, you go shoot a basketball or you try to write a computer program, if it works or doesn't, right? It's very clear, and there's a very quick, what I call feedback loop. You know the information quickly. You're getting feedback. You go to shoot the basket. Does it go in the hoop or not? You're getting feedback every time you do that. When you're picking a stock, you say, okay, I'm going to buy Apple or I'm going to buy Google or whatever you buy. And then you have to wait. And you wait a year. And even if it goes up, that doesn't mean that you were right. For example, let's say you bought GameStop in middle of 2020. You're like, hey, I think there's this great thesis, whatever. And then, January 2021 comes along and the stock shoots up a ton. And but it had nothing to do with why you bought it. You had no idea it was going to become this meme thing that got, that took the world by storm. You had no idea that was going to happen, right? And there's no way you knew that. Maybe there's some people on Reddit that knew that, but most people did not know that, right? So you got lucky, basically. And so that's my whole point is you and I can pick a set of stocks, and just because yours outperforms mine doesn't necessarily mean that you're a better stock picker. Now, if we did that for 10, 20 years, probably we'd figure out who's the better stock picker. But if we just do it for 1 year, 3 or 5, it's really tough to know over a short period, right? Whether you're skilled or lucky. And so that's the kind of the big issue here. It's they did a study and they found basically 10% of stock pickers actually have skill, right? So let's say we can identify the top 10 after a certain number of years. And let's say we can also identify the bottom 10, they just absolutely suck. The middle 80, we just don't know. So that means 4 out of 5 stock pickers have no idea if they're good. So there's nothing wrong with picking stocks. Take a small percentage of your portfolio. You want to take a 5%, 2%, whatever, and put it in individual stocks for fun. That's fine. I don't have any qualms with that, right? But if those go down, you could lose it. So just be ready for that. My issue is just
one thing on that as well is when you're looking at stocks in particular, there is different theses to be applied. people will say, like, there's a top-down approach. You can take like a macro view and then look at what's in within the sector or whatever, or you can do kind of a stock screener approach whereby you put down different PE ratios and whatnot, and then you'll have a collection of stocks, and then that's what you're going to analyze. Like, is that what's feeding into, like, so regardless if you do that or not, you could still end up being a shit stock picker or someone who's actually successful because it's based on luck outside of those factors? Do you think, like what's the other factors at play in? Is it because it's idiosyncratic risk and it's just based on a company?
I think it's idiosyncratic, but it's also just like you can do all this analysis on macro, whatever, etc. Pick a stock, and then it goes up or down, which has nothing to do with your analysis, right? Like the example I gave with GameStop is very extreme, but that's like the easiest example because it's very visible and you can understand it well. Like you clearly knew anyone who bought GameStop in the middle of 2020 on some thesis of them turning around the company had no clue what was going to happen in January 2021. So they clearly just got a lotto ticket, basically, right? And so in that case, it's easy to identify that this was luck. But in another case, you can buy a stock and then, oh, it beats earnings, does this or that. And you think it was your thesis, but it's not. It could be something else that happened, right? And so that's the thing where it's very difficult to know these types of things. And so I'm always like skeptical to tell people like buy individual stocks and invest in them because, you're like, well, I have this approach and I do this or that. And it's like, it's tough to know if that works. And you're not going to know for years if that's right. And what if it works in one market regime, but it stops working? That's another thing too. Like you think like, oh, just because you're skilled in one area doesn't mean you're going to be skilled later. I mean, you can think about like, games evolve, right? Things that used to work don't work anymore. Like for example, the simplest example I give this, back in the day, Warren Buffett and Benjamin Graham used to buy something called net nets. Now, what is a net net? A net net is a company that is trading on the open market for less than its liquidation value. That's like buying a suitcase with 100,000 pounds in it for a price of 50,000. Imagine someone's out selling a suitcase right now on the street corner. It's a clear suitcase. You can see it's 100,000 pounds. You know with 100% certainty it is actual money. It is not counterfeit. It's real. And they say, I will sell this to you for 50,000 pounds. How could you not make money, right? Net nets used to exist all the time. You can just look them up in the newspaper. Those don't exist anymore. If they do, there's some other crazy thing that, because even if you tried to buy it, there's a crazy operator who's going to destroy value. Who knows what it is, right? So net nets don't exist anymore, basically. And so because of that, the game changed. So if you're like, I'm just going to be a net investor, it doesn't work anymore. And so that's another thing to keep in mind is your approach may be relevant in one regime and not another. So there's so much I can say on this for so many reasons. I mean, the last thing I'll say on this, then we can move on, is like, think about the use of your time. Like, were you born to be a stock picker? Maybe you were, and maybe you should be doing that. But I think most people are not born to be stock pickers and do that and spend all that time. Like, if you think about like, what's the return on your time? Let's say you have 10,000 pounds, right? And let's say in a good year, you would get 10%, right? So you're going to get 1,000 pounds on your return, right? But let's say you spend 10 hours a week and you increase that to 15%. That's good. 5% alpha is good, right? So instead of getting 1,000 pounds, you get 1,500 pounds, right? So you just got an extra 500 pounds. But remember, you spent 10 hours a week researching this stuff for a year. So 10 times 50, you spent 500 hours for 500 pounds, right? You got paid £1 an hour to do what? Like, you see the point. If you're a billionaire, yes, that research matters. If you have a lot of money under management, your research and your skill leveraging that's important. But if you have 10,000 pounds, like, oh, I'm going to beat the market by 5%, like, bro, you just worked for £1 an hour for a year. Like, I literally just wrote a couple of blog posts and I made way more. Like, you probably could have done something else. You could have gone and, done whatever, some other side job and made way more money. And then you could have put that and invested and wait till you had more money, then your stock picking skill would have mattered, right? So that's another thing to think about is like, what's the return on your time? And there's so many people who are like, oh man, I'm going to beat the market and this and that. It's like you spend all this time and like you're working for like pennies, like on the dollar or something, right? You're, whatever. I don't know what the UK version of that quote would be, but like you're not working for a lot of money. And so I say to you is like, think about like what time you're spending in this endeavor and whether it's worth it, right? Obviously, if you have a lot of money, then yes, it matters, but most people don't. Like I've been obviously saving for a while and I look at the return on my time in my brokerage account and it would still not be worth it versus me putting out more blog posts or doing content or trying to sell more books, etc. It's not even close to worth the time.
Of course, and I completely agree with that as well. I completely agree. It's so interesting because like it's all about going back to the original thesis about income and scaling up your income and doing different factors. It's like you can use like, the market to increase your wealth, but because it only yields 5%, and 5% of 1,000 is very, or 10,000 is very little. Therefore, you should only allocate a certain amount of time to it. And that's why the passive investing approach is so intelligent. And I always think about that as well. That's why I turn off all my alerts for stuff, because I was like, at the end of the day, I'm not even making that much money from this, you know? In my podcast, I can just double down on that. I can see a clear, well, not necessarily clear, but I can see a better path to high monetization, because it's like, okay, you're at this level. If I produce them into work, I'll go to this level. It's a bit more input output, whereas a lot of the time you can get caught up on the emotional side of it, invest so much time, invest so much money, and the return doesn't come back. So yeah, I think it's definitely a huge shift we need to have, but it was definitely driven as well by the likes of Twitter, Reddit, got people more involved. People were stuck at home. They had fuck all to do. Didn't really, some people started online businesses and they killed it, but a lot of people didn't. And they got caught up in the market. And then it became habitual. Remember one of my friends that I podcast with a lot, how I first got interacted with him. He said, he put up this post on Twitter that went viral. And he said that he was waiting in the bank. Was it the bank? He was waiting in the supermarket. And the guy in front of him was watching live price action of Bitcoin. He was just in a queue for 20 minutes, and he was just watching the price on a one-day chart just flicker up and down. And that's what maybe the last 2 years have done to us.
Yeah, I mean, a lot of things have been gamified. I don't know what the culture is like in Europe and elsewhere, but I know in the US it's become like a game to, invest in, especially crypto. Crypto is like a 24/7, casino in a sense, right? Like you can go check it right now. We can go check while we're on this thing, Well, I mean, US markets are open at the time of this recording, but let's say they weren't, anytime, like you can go check the crypto price, right? And it's kind of wild to think about. I think it's kind of cool, but at the same time, it's also like, you can imagine like, finding out you went to sleep and you wake up and your portfolio is down 20% because nothing you did, you just went to sleep, right? And it's like one of these wild things, like, it's such a weird time right now for investors, but we'll see what happens going forward.
Yeah, and that's the last area I want to get into as well. So actually, firstly on that, so I have a close friend who made absolute bank off crypto last couple of years. Like he was very, very smart guy, very intelligent, understood like a lot of things were happening behind the scenes, and he accumulated like maybe like six figures at a very young age. And he said that that during that period he would wake up with genuine heart attacks because he'd go from 100K to 60K to 140K to back to 50K, and this was 2-3 years ago, So he said that because like he got out of it, and then he was like, "Thank fuck that's over." He was like, he had felt like he'd been through the war so many times, and he ended up obviously in a very profitable position. But I thought it was so interesting to analyze. He was like, "I genuinely would see swings of honestly 30K in the space of a day, and I had to mentally manage that and just come to terms with it, which is crazy. It's because it's just open 24/7."
Yeah, and I think once you start like turning that 30K into actual consumption, like think about how much your last vacation cost. And even if you had a very expensive vacation, let's say you spent, I don't know, 5,000 pounds, that's very expensive, right? That's 6 vacation. Like that's like vacation for the next few years, right? Or that's like, and even if you just took one big vacation a year, that's, 6 years of vacations you just lost, right? When you start to like move it into actual consumption, that's where it kind of gets a little wild.
Yeah, it's crazy. So the last area on here I wanted to chat about was about the kind of emotion side of it. So how do you even proportion some of this? I know we've said we put away our phone, we don't want to look at it, but especially in these areas, like, how do you continuously think long term? Do you go back to the data? Do you advise that? And then advise just putting away your phone? Like, how do you think of it from an emotional perspective?
I think another piece of this, which I didn't get into with the individual stock thing, but it has to do with identity, right? And so like, when the market drops, the S&P 500, international market, whatever index fund I'm in, drops 10, 20%, I don't get bothered at all. I think the issue is I know this is impacting everyone else. This is like the default choice. Like this is like, hey, here's the choice you should make. This is the default. Anything off of that deviation is now on you. Like you made this choice. And so if you go and buy Apple or you buy Nvidia or you buy Amazon or whatever company you buy, you are now deviating from the active choice, from the standard choice. And so you're making an active bet. Now your identity is caught to it. I still remember owning individual stocks, and I would check, and like they were like 1% of my net worth, like not even that much money. I'd be going up or down, $50, $100 maybe in a day or something, very small, right? And I was checking those things all day while the other 99% of my portfolio is fluctuating much more wildly, right? I mean, even though the fluctuations might be smaller, the percentage-wise, on an absolute basis, the dollar amounts were, way, way more, right? And I never cared about it. Like, oh, market's down, who cares? And I think it's because of the identity thing. And so when you identify with your investment, like, oh, I'm a Luna person, I'm a lunatic, or I'm a Bitcoin maximalist, as soon as you start to identify with these things, you start putting yourself in a spot where you can't be rational anymore. And so I think you need to kind of remove yourself from that. Don't identify with your investments in the same. Like, I'm not like I'm an S&P 500. Like, I own index funds. I don't know if the US is going to outperform international markets. I don't know if it's going to outperform farmland or REITs or royalties. I have no clue, right? I'm going to be honest. I don't know. And I don't think anyone else does either. You can make arguments here or there, and that's fine. But own a basket of this stuff, see what happens, and kind of go from there. And if there's too much risk, take some of the risk down. If there's not enough risk, add more risk. Like, just adjust that way. And if you own enough of the idea here isn't to maximize your return. It's just to get you to live the life you want to live, right? And I think that those two spaces are very different, right? I think there's going to be very few people who have to get the exact right mix to get to where they want to go, right? It's mostly people are going to either completely overshoot or going to be completely under, depending on their asset allocation, right? It's very unlikely you're like, oh, I got to right exactly where I need, and I died with exactly $0. Like, that's very unlikely, right? So I think most people will probably be fine. And it's just like, own a broad basket of income producing assets. Like, the world is creating value, and just own a piece of that. Own some very, very, very small share of that. And that's the goal there. So that's what I would say to people is, like, as soon as you start jumping off and saying, I'm going to buy these special sector or this special this or that, you're now identifying. You're moving from the default choice. And as a result, you're going to identify with it, and you're going to spend more mental energy watching it, caring about it. I don't care what the market's doing right now. I don't know. It might be up, might be down. Literally don't care. And it's affecting my wealth in a very major way, right? You know, it's like, as your wealth grows, that 1% move gets bigger and bigger, right? You know, I had days in March 2020 where I lost more than I saved in like 2 years. Like, I saved in, I think the first 2 years of me working, because I didn't have much money, I didn't save that much. I lost more than that in a single day than I saved in 2 years of work, right? So think about that. Now, if you do this right, I'm going to lose more in a day than I've saved in like so far my whole life, right? And so that's kind of the thing to think about, but it's just like, don't identify with it. Don't identify with investments. It's not you. It's something outside of your control, so you don't identify with it. When it's something you did pick, you can control it. And so that's what's going to get in your head and mess with you.
Yeah, and that's where I'm kind of struggling at the moment, and that's what I'm trying to focus more on, because that's the basis from your book. It's how I'm trying to learn everything from it, because a lot of the times when you don't feel that adversity first, that's when you start clinging to it. And I'm always thinking about the Bitcoin maxis in those scenarios. So I just listened to a podcast with the guy who wrote the Bitcoin Standard. Like, great book, like very, very inspiring dude, very intelligent dude. No bad words to say about him. But what I would say is the fact that because he can be quite stuck in his particular ways, he's not open towards anything else, or he's very much in one line of work that everything else doesn't matter, and therefore he's facing all that kind of pullback and all that kind of issues. Which I suppose, if you were to take numbers out of the way and take markets out of the way and wealth out of the way, that's not a great way to look at ideologies and different kind of concepts in general. You know, if I told you that I'm only interested in this very specific diet, well, then it might not be very helpful. If you're like, oh, I have all this data, I have all this information to help you, and you can do something much better. So that's the most extreme example, of course, because that's going to be the most extreme caliber of people in that area, and that's their own decision. But it's kind of like, for the average person, that's kind of not how you should invest your time and your wealth, I think, when there's many different things going on.
Yeah, it's like there's that quote, do you want to be right or do you want to get rich, right? And so that's people trying to, I think the tech sector, you're trying to be right. You're trying to like predict the future and feel good about yourself that you predict the future. Just buy the index funds and just get rich. It's going to take a while, but it'll get there. Trust me. Like, I've only been doing this for 10 years, right? And obviously income matters and a lot of these things, but like, I've been doing this for 10 years, and I've just seen like stuff change in my life that I could never expect, right? And I'm very fortunate, but it's just like, because I've been following this advice for a long time. I've been perfect at it, but I've been pretty good at it. I've been basically low cost index funds for the last 10 years. You know, obviously the market's gone up a ton, and even if it went down, I would still be, it would have to decrease by I don't even know how much for me to like be underwater relative to my cost basis, you know? So, but yeah, that's my takeaway there. So I would just kind of ask people to kind of, think about that, and, think about kind of where you're investing.
Of course. Nick, thank you so much. Where can people find like all your book, all your details? I'll also have them all like in the show notes as well, so like you can go directly to there as well.
Yeah, so you can find it on Amazon, on I think Harriman House is my publisher. You can find that Just Keep Buying there as well. You can follow me on Twitter at Dollars and Data. I do respond to all my DMs. So if you send me a DM, I will respond to it. I don't know when, but I will get to you. So I try to respond to every single person. And that's it. Yeah. So, and you can also find my blog of dollarsandData.com. So
sick. Nick, thank you so much. I really appreciate it.